Okay, so you're a technical founder. You've got this incredible idea, right? But here's the thing that keeps you up at night. You need money, but you're terrified, absolutely terrified, of losing control of your baby, the company you're pouring everything into. Well, in this explainer, we're going to get right into it. We'll break down exactly how you can get that crucial pre-seed funding and stay in the driver's seat.
I mean, this is the big one, isn't it? How do I raise money without giving up control? You've got the code, maybe you've even got a working demo, but you're not quite ready for the big leagues, the major VCs. You know you need some cash just to keep the lights on, to keep building, but man, you've heard the horror stories, right? Founders who took that early check, and a few years later they own just a sliver of their own company. We're going to make sure that doesn't happen to you.
And let's be clear, this is for you. We're talking to the robotics engineer tinkering away in a garage, the AI PhD with a totally wild idea that just might work, the tinkerer who spent 3 long years getting that prototype to finally fire up. This isn't for the trend chasers. This is for the real builders, the innovators who know their tech is a game changer and are dead set on building something that lasts on their own terms.
So here it is, the classic founder's dilemma. It's this constant tug-of-war, right? On one side, you desperately need capital just to survive. But on the other, there's this crippling fear that taking that money means handing over the keys to your vision. It feels like a lose-lose situation, a totally impossible choice. But what if it's not? What if there's another way?
All right, let's dive into the problem. We're going to look at the most common pre-seed traps. Seriously, this is why most early fundraising efforts just go sideways. Once you see these traps for what they are, you can sidestep them completely. It's the first step to really setting yourself up for a win.
Okay, trap number 1, and this one is huge. Raising way too soon. Look, you've built something awesome. People are excited. They're telling you, dude, you gotta go raise money. So you do. But here's the problem. If you don't have a real defensible moat, like some solid IP or a patent, you're basically walking into that investor meeting with your hat in your hand. You have zero leverage. And when that happens, guess who sets all the terms? They do. And that means you end up giving away a massive slice of your company for what feels like a pretty small check in hindsight.
And that leads us right into trap number 2, focusing on the money itself, not the value it creates. People think early capital is just about extending your runway, paying salaries. But that's not the whole story, especially for a deep tech company. Every single dollar you raise at this stage should be laser-focused on one thing: building defensibility, making your tech so unique, so protected, that nobody can just waltz in and copy it. If your pre-seed money isn't building that moat, you're not just burning cash, you're burning precious equity for nothing.
Which brings us to trap number 3, and it's a killer: having no plan for your IP. So many brilliant founders just build out in the open. They share their secret sauce, their core innovation, thinking it's all about collaboration. And then, bam, someone else copies it. Or even worse, they go and patent your idea before you do. All of a sudden, you're not raising from a position of strength anymore. You're raising out of pure, raw desperation.
So what happens when you fall into these traps? The whole power dynamic gets completely flipped on its head. It's like you're playing poker, but you've shown your hand before the betting even starts. Your leverage as a founder, it's basically zero. You've got a cool idea, sure, but no real protection. Meanwhile, the investor, they have all the chips. They've got the capital you need just to stay in the game, so they get to name the price.
Okay, that sounds pretty bleak, I know. But what if you could totally flip that script? This is the turning point. This is where we talk about the solution. It's all about engineering a massive power shift, changing the entire dynamic of that fundraising conversation before you even walk in the room. So what's the secret sauce here? It's one word: leverage. And for a technical founder, leverage isn't some fluffy business buzzword. It's something very, very real. It's the process of taking your raw invention, your code, your AI models, your clever algorithms, and forging it into a real, protected asset. We're talking about a patent or a trade secret, something that has undeniable standalone value. And listen, if you take only one thing away from this whole explainer, let it be this. This is the big one. Most people think you raise money to get leverage. That's backward. The right way to do it is to build leverage so you can raise money. Let me say that again. Don't raise to get leverage. Build leverage to raise. That one simple flip in your mindset, it changes everything. Okay, great. Build leverage. Sounds good, right? But how do you actually do that? Let's get practical. Let's open up the playbook. This is all about building your moat first, long before you even think about putting together a pitch deck.
There's a term for this approach. We call it seed strapping. Think of it as a smarter way to grow without the constant, soul-crushing stress of chasing investors. So instead of burning all your time in endless pitch meetings, you're focusing on what actually matters, making your product better and protecting your core innovation. Imagine that. No board meetings to prep for, no drama over the cap table, just pure, focused progress.
So how do you seed strap? You do it with what we call non-dilutive sprints. These are just short, high-impact projects that build tangible value without costing you a single percentage point of your company. For example, Step 1, file a provisional patent on that core algorithm you've developed. Boom, asset created. Step 2, run a small pilot test with a friendly partner. Get some real-world data, some proof that this thing works. And Step 3, automate a key workflow. Free up your own time so you can focus on building. See, each little sprint makes your company stronger, more defensible, and more valuable.
Now, once you've done this, once you've actually built this leverage, the whole fundraising game changes. It looks completely different. You're not walking in asking for a lifeline anymore. You're walking in offering a golden opportunity. You are finally raising from a position of real power. Now, put yourself in the investor's shoes for a second. What do they see? They see a founder who isn't desperate for cash. They see someone who's been incredibly thoughtful and strategic. You've protected what matters. You have a clear plan for the next step. You know exactly what you're raising for. You're not just vaguely asking for money, you're asking for a specific amount to achieve a clear milestone. Let me tell you, that is the kind of founder investors are tripping over themselves to back.
So, in the end, it really all boils down to this one simple question. Are you raising to survive, or are you raising to amplify? Are you just looking for enough cash to scrape by for another 6 months? Or have you done the hard work up front, built that moat, and now you're asking for capital to pour gasoline on a fire that's already burning bright? You're asking to scale something that is already strong, already protected, and already valuable. And the best part? The power to make that choice is 100% yours.